Good evening, and welcome back to Grey Man's Profits. Today is the second video for beginners for different terminologies that you'll find across the charts. And the main ones that I want to focus on today are FVG, or Fair Value Gap, OB, for Order Block, or, and this is not a terminology that you'll see written on the charts, but it's good to know, and this would be the kill zones. Okay, first of all, so a fair value gap, all it is that when price has changed between one candle and another, that it's left between three candles, whatever time frame you're on. 1 minute, 5 minute, 15, an hour, 4 hours, or a day. It doesn't really matter. The only difference is that, of course, that price has changed from one candle to another, and it has changed quite drastically. So all this indicates that, of course, I will explain, is that for this candle, whatever time frame it is, has started here, retraced, gone up, and then retraced back down to finish here. This would be the indicator of your 1 minute or 5 minute. Then for the next candle, it is retraced back into the space here and then shot up. All this indicates that, of course, there were a lot of buyers in that moment, in that time frame. What this has done is this has changed price quite drastically. It has reached a peak and dropped back down, finishing there. What this indicates is the next candle did not retrace back into that space whatsoever, but continued the bearish market. This indicates that there has been a space left between the first candle and the third candle where liquidity hasn't been taken, meaning that they've left cash on the table, basically so that they can continue their track. And they're planning to continue in a bullish market. Sorry about that. And then the same can be said for, of course, a fair value gap in a bearish market. So, prices opened up here, retraced, shut down, and retraced again. The second candle has opened, retraced a little bit, and shut down. This indicates that, of course, there have been more sellers than buyers, and quite a lot few. So either lots and lots of traders have made the same decision at the same time, or a firm with much more capital has come in and gone, okay, we're going to move the markets in our direction, which, of course, has led a big space and continued to the third candle where it's continuing its downward motion. This has left a gap of space, which once again has not been reclaimed. Its liquidity still on the table. And this is important because most of the time when trends go down, they have a habit of falling back into the fair value gap. So in this imaginary scenario, we'll do it with the bearish market. So what will happen is here, the fair value gap is formed over, I'm going to say, a 1 minute time frame. So each one of these candles is 1 minute. So let's say in this minute, in this minute, in this minute, there was drastic change in minute 2. Let's say that the trend continues down and then changes with a break of structure, has a habit of tapping back into this space. So another candle, whether it's, let's say, 10 minutes, an hour, half an hour, or even in the next 5 minutes, has retraced back into this space, it means that they've grabbed the liquidity, it's wiped it out, so they've taken all the money that's available in the situation, and it's called a liquidity sweep, where they've gone from candle to candle, and that allows them once again to continue either upwards if they wanted to, or to retrace and back down to continue downwards. I understand that that's a hard concept to grasp, but the only thing that you need to know at this point is just what a fair value gap is and how it can affect. So usually, all it does is indicates that the market is going to retrace back into it. Not always, so be careful. Just watch the markets. The second one that I wanted to discuss is an order block. So, as an individual trader, you have to remember that out of everyone that's placing a trade, whether it be firms, whether it be hedge funds, whether it be independent traders, whether they're scalpers, swing traders, day traders, or investors, you have to remember that us as traders only make up 5% of the market. Otherwise, it's big firms with huge abundance of money that come in and they control the markets. We're not the big fish. We just pick up the crumbs. So, when an order block like this comes in, and you will see it as a block, whether it's blue, red, whatever it is, and you will see an OB with a plus. This indicates that a firm has gone, okay, I want to buy a huge amount of this stock, or whatever it is, whatever we're calculating. And in that moment, they've gone, okay, I want to buy it at this set price. So the firm has gone, okay, I'm going to set aside, random number, 50 million shares of this product at this price. When you see that, usually what that will indicate is that the firms will try and reduce price or gain price if it's above or below to fill this order block. That way, their orders can be filled. This private firm or an individual can buy this huge amount, and then of course it will have the opposite effect on the market. So if, let's say, you are at a higher spot, so the market was before bullish, what it will do is an order block will be filled, the price will continue to rise, and then we'll continue to try and fill this order block, meaning that once it is filled, the price can skyrocket again. It doesn't always work, but it is a huge indication of where market wants to go. And especially when you see order blocks, it means that it's out of our control. Okay, I'll go into that for some more detail another time, but I'm glad that you're familiar with what an order block is, and then also what the size of the competition actually is for us traders. The last concept, and this one's an important one, is the kill zones. So, the term kill zones is only because, as I discussed in my last video, that there are three main parts for the market for the day. Often there is Asia session, London session, and then New York session. There might be some other players that come in during these times that might move the market. But statistically or regularly, these three players, when their market opens, they are the main players where the main firms move money. The reason that kill zones come into contact and become meaningful is between these three big firms working, there is a little space of maybe an hour or two, and an hour or two between the sessions waking up for their starting time. Meaning that if you are a trader and you are up between, let's say, the New York AM session is the main heat, where lots of manipulation or distribution has happened. Then we've gone into a period where there's less buyers and sellers, less volume, less people buying and less people selling. And we're waiting for Asia to wake up and start trading. So at 8 o'clock for them, let's say 2 or 3 hours beforehand, price without active buyers often has a habit of either consolidating and staying at a solid price or slightly dropping down. If you're smart, then you can target, okay, I can either take advantage of this consolidation or accumulation, and I can try and do small scalping trades. Or you can leave it and go, okay, I'm going to watch how price moves downwards or upwards in this time frame so that I can take advantage of the next session's opportunities. So you go, okay, between New York PM and Asia waking up, the price dropped back down. You could have either taken advantage of the price dropping back down or wait for Asia to wake up and go, okay, they are most likely going to buy aggressively to try and balance out the price. This becomes a winning situation for us. Okay, well, those are the three concepts for today, and I hope to see you again. Have a lovely evening.